What's up everyone, my name's Robbie, this is Robbie in Manila, and OMG, this is gonna be a good one. So my last video focused on the best yielding ETFs, and this video is very different because it's gonna be going over the best growth ETFs. But if you do want to watch that video about yield, I'll put a little card right here and I'll also put a link below so you can check it out. So unlike that last video, this video is really about growth ETFs that have a lot of potential to grow, but also definitely have more risk. And so what I did was I took the best ETFs that I could find and I risk adjusted them to find the best ones for you so that you can take the proper amount of risk to get hopefully a great return. So that's all. I want to go ahead and get into this intro as fast as possible, so let's roll it and let's get going. Okay everyone, let's go ahead and get started, but first, I am helping you find growth ETFs, so why don't you help me grow my YouTube channel by hitting the like button. Okay everyone, I hope you're excited. I am. So we're going over the 5 best growth ETFs for 2021. Here's the deal. So a lot of these growth ETFs are growth ETFs that usually would perform great in any market. Some of these are actually sectors that I think are going to do better this year. And by the way, if you want to see like which sectors I like for this year, which I don't like as much, I'm gonna put a video right here on a card. Click that. I'll also put it in the description below. Take a look. Basically, it will show you some of the reasons I put a couple of these ETFs in here, and so that'll help explain things a bit more. So let's go ahead and let's begin. So our number 5, and this is not ordered in any specific way, like my other video I made on the yield. Those were actually ranked in my favorites. These are actually all just ETFs that I like for growth. Any of them would be great. You could add a couple of them to a portfolio, add all of them to a portfolio, whatever you want. But I think these are all great choices. So first here, we have the Invesco S&P 500 MidCap Momentum ETF. This is XMMO. So this is a momentum ETF, and if you don't know what momentum is, momentum are stocks that are experiencing high increases in stock price. So a momentum stock might have been going up for the past like 3 months, 4 months, 5 months, and so this fund is actually trying to find the best stocks, the best momentum stocks that are what are called mid-cap stocks. So they're not huge companies, like they're not like an Apple or a Google or something like that, but they're like mid-sized companies, okay? So this one, the product detail here for XMMO, it says the Invesco S&P Mid-Cap Momentum Fund is based on the S&P Mid-Cap 400 Momentum Index. The fund will invest at least 90% of its assets in component securities. The index is composed of securities with 80 securities in the S&P Mid-Cap 400 having the highest momentum scores, okay? So essentially what they're doing is they're really trying to figure out momentum scores and figure out which stocks should be added to this ETF. And, you know, part of this is really a managed ETF, okay? So that's what they're doing. And then we're going to go over here and we're going to take a look at the expense ratios and all this good stuff that's very important. So the expense ratio is 0.34%. Not too bad. I mean, this is a momentum ETF. I mean, I'm actually very happy with that. Of course, it's not like an ETF that just tracks like an index, which has like a very low expense ratio, like 0.03%, right? So I'm very happy with this expense ratio for what you're getting. The 5-year category rank, it's in the 13th best ETFs inside its category. That's great. The price change versus the S&P 500. So the price change is 105% more than the S&P 500 over 5 years. So it's really outperformed the S&P 500 over the past 5 years. That's a good thing. That's what I want to see in a growth stock, or in a growth fund ETF. The distribution yield is 0.61, so you get a little bit of yield. It's nothing spectacular, you know, just like kind of like peanuts, but you get a little something. So that's good too if that's what you want. But really, we're going for growth here. Here we have the top 10 holdings of XMMO. We got Solar Edge Technologies. A lot of these, because it's a mid-cap ETF, I mean, you might not know what these are. But, you know, Boston Beer, I mean, I know Boston Beer, so there's that one if you know that. But a lot of these I've actually not heard much of, don't know much about these stocks. So, that's just what you get in an ETF like this. They're finding these stocks that you might not know about. So if we go to the returns, the market return, not including the reinvested dividends or anything like that, for the past 5 years, 21.61% annualized. That's really great. And then if you look down here at the S&P 500, it's 15.22% annualized. So, it's great. It's even outperformed it over a 10-year period, 14.49 to 13.88. So, this is great. This is this is the things I want to see. I want to see outperformance, but risk is a very, very, very important component of any ETF and any fund in general. So that's what we're going to try to figure out on this next part, which is the risk, which I think you should pay more attention to this than probably anything. So the first thing you should know is that XMMO is a 4-star rated ETF. That's great. That's the Morningstar rating. The best you can have is a 5, so that's good. The risk versus the category. So how much more risk does this take than the category? So it's average. So it doesn't take more risk than the category. It doesn't take less risk than the category. But the return is above average. So that's what I like to see. I like to see risk that's on this lower part and then return that would be on the higher part. You wouldn't want average risk but low return. You wouldn't want high risk and low return, right? So it's fine. This is what I like to see. It could be a little bit better. It could be risk is lower or low and then return is high, but you don't always get that, right? So it's okay. Next is alpha. So alpha, outperformance, 8.38 versus the category, outperformed versus the index, higher alpha than the index. Beta, basically it's risk, so 1%. So it's actually basically doing exactly what the market's doing, okay? Which is like, so for example, let's say if it's tracking the broad market, the S&P 500, S&P 500 goes up 20%, and then it goes down 30%, like, I don't know, in like a day, which would not happen, but just, play along with me. So if it went up 20%, this also would go up 20%. Then the next day it went down 30%, this would also go down 30%. So it basically, the beta is how much the market is moving up and down, volatility, and then how much more or less than the market it is going up and down. There you go, that's beta. Standard deviation is like the range of prices. So there you go. It's got a good standard deviation compared to the index and to the category. It's got stuff. These are things that I like to see. Great. So not too risky. So it's within like what I'm liking so far. XMMO capture ratios, very important. Pay attention. Pay attention to this one, okay? So here, the 3-year, this is the 3-year capture ratio. This is the 5-year capture ratio. What this means, the index. So the index is 100. So that's like the baseline, okay? If you do better than 100 on this, that means that you're outperforming on the upside. So when the market is up, then if you're like 114, which is showing here on the upside for the 3-year, it's overperforming on the upside. The market's at 100, it's going up to 114, so more. On the downside, then you want to see higher upside, but you also want to see lower on the downside, right? Because that's exactly what we're trying to do. We want more return with less risk, of course, right? So the downside's 85. So upside 114, downside's only 85 compared to the index. Of course, we have 100. But then the category, it's doing better than the category. It's got overperformance on the upside, and on the downside, it's not having as much downside risk, right? That's good. That's what we want. The drawdown, the maximum drawdown is very important, 21.09%. Versus the index and category, pretty much all in the same area there, so that's fine. All these drawdowns you're going to see are really around the time the pandemic hit, so that's the drawdown peak and valley and stuff like that. So in the 3-year, of course, you're going to see that. Also in the 5-year, you're probably also going to see that, honestly, and this is the 5-year. So the 5-year upside capture ratio is 120, even better than the 3-year, and then 99 on the downside. So again, it's outperforming on the upside and the downside versus the category, okay? This is what we want to see. And so, this is what I'm looking for when I'm trying to find these ETFs. I'm looking at all these different risk metrics to try to figure out, does it have a proper return given a proper amount of risk, okay? So next we have number 4, Invesco QQQ Trust. So Triple Q, this is a good one, a very popular ETF. Just a little bit about it if you've never heard of it. Invesco Triple Q invests in some of today's most innovative companies all in one exchange-traded ETF. It tracks the NASDAQ 100 index. The index includes 100 largest non-financial companies listed on the NASDAQ based on market cap. Okay, so it's a NASDAQ tracking index. You're going to need a lot of tech, of course, stuff like that. The expense ratio 0.20, not bad at all. The 5-year category rank 7%. The top 7% best ETFs, great. Price change versus the S&P 500. The 5-year 101%, awesome. Outperforming the S&P 500. I mean, that's great. And then the distribution yield 0.55. A little bit of yield, not a lot. Of course, this is a growth ETF video. We don't care that much about yield, but maybe it's like a little cherry on top, right? Next, we have the holdings. Of course, it's NASDAQ. We got Apple, Microsoft, Amazon, Tesla, tech, right? All these tech names, right? Okay, FinTech, PayPal, right? So, but there you go. So, that's exactly what you're getting here. If you think tech's going to have a bad year this year, this might not do that well. If you think it's going to have a great year, it might do pretty well. So, let's go to the next one, QQQ returns. Let's look at the 5-year first. The market price, 23.99 for the 5-year versus the S&P 500, 15.22, outperformed against the Russell 1000 growth. So the Russell 1000, the top largest 1000 companies, and of those, the growth stocks in that Russell 1000, 21%. So it's beat. Triple Q has beat the Russell 1000 growth trailing USD. So doing good. The 10-year, look at that, 20.36% return. OMG, that is a good return, right? So, I like that. I want that myself. So, I wish I had just invested in this 10 years ago, but I didn't. So, versus 13.88% for the S&P. Now, really quick segue. When I invest, I try to beat the S&P 500. That's my gauge. In my opinion, you need a gauge. You need to measure yourself versus something, and for me it's the S&P 500. So I'm trying to beat it however I can. If it's adding ETF like a Triple Q that might have the ability to do that, that's what I'm doing, right? So stocks, ETFs, whatever else you might be able to find, but at the end of the day I'm trying to beat the S&P 500. Triple Q risk, again, very important, pay attention. QQQ, 5-star fund from Morningstar, awesome. The risk is above average, but I cut that part out, but this is the risk is above average, return is high. Good. So as long as this part is lower than this part, right, above average and then high, we're good, right? So, and if you like that high for return, great. We got the alpha, 10.73, more than the category and the index. The beta, 1.05. Little bit more volatile than the category and the index, but not a lot, just 0.01, so not too bad. And then we got standard deviation actually is the same, just a bit more than the category and the index, not so much more that it concerns me, so pretty good. Next we have the capture ratios. Check this out. I mean, these are really good. I'm really liking how these look. 128 on the upside versus the category, so better than the category, and on the downside, it actually did better on the downside at 91. That's exactly what I want to see. On the upside, 126 versus 108, better on the upside. Downside, 97, better on the downside, exactly what I want to see. Fund, percent return, percent drawdown from the peak, negative 17% versus the category, it's about the same, right? And then for the index, it's a little bit more than the index, not too much, but that's good. So Triple Q, good fund. Okay, number 3, we have the SPDR S&P 500 Healthcare Equipment, XHE is the ticker symbol. This is a this is a play for me that is going more with a sector that I think is going to do well, and even kind of a part of a sector. Again, just take a look at that video about the sectors and which ones I think will do well if you want to see this, but let's go on and see what I got here for the XHE. Okay, so the key features for XHE. The SPDR S&P Healthcare Equipment ETF seeks to provide investment results that, before fees and expenses, correspond generally to the total return performance of the S&P Healthcare Equipment Select Industry Index. Okay, so anyway, take a look at that. Pause the video if you want to read it, but let's move on. Healthcare equipment, I think is pretty self-explanatory. Expense ratio, not too bad, 0.20. It's fine. Category rank, 10%. It's in the 10% best ETFs in its category. Like it. S&P 500, 5 years. The price of this versus that, 85%. And there's no distribution yield, okay? So these companies are generally not paying dividends. So what's this tell me? Okay, 85% better than the S&P 500. Well, that's great. The two we talked about before had a little bit 100% or more better than the S&P 500. Why do I like this? Because I like this sector right now and where we are today in 2021. I just like the sector. So I think that this has good upside potential based on the sector. So these are the top 10 holdings. I mean, honestly, I don't know any of these stocks. I do not know anything about healthcare equipment. That's one of the reasons I invest in ETFs, is because if I don't know about like healthcare equipment, at least I can just go have someone else do it for me. I can pick a sector. I know I like the sector. I don't know anything about these specific companies. I've never read an annual report of one of them. Don't know much, okay? So, but there's 82 holdings in this. And then we look at XHE versus the S&P 500. We got 20.90% 5-year versus, well, it doesn't have the S&P 500. It's got its broad-based index, MSCI, ACWI, NR, USD, 12.26. Better, okay? Now we got a 5-star from Morningstar, average risk, and then above average return, exactly what we want to see, right? We went over this. Alpha, so 10.65 versus 6.67, 6.76, 5.53, better alpha, thumbs up. Beta 0.95. 0.9 versus 0.91, 0.76. It's more volatile. It's more volatile than the index, actually. So if you want to maybe consider that, you do so. But actually, I guess it's more volatile than the index here, the MSCI index, but not. I think the S&P 500 index is the index they're tracking the beta against. If that makes no sense to you, just don't worry about it. Whatever. The standard deviation. It's a little bit more than the index. The category, it's about the same, so that's fine. And then the 3-year and the 5-year capture ratios, 117 on the upside versus the category 107. Like it, thumbs up. 78 on the downside versus 85. Like it, thumbs up. Next up, 121 on the upside for the 5 years versus the category 107. I like it. And then we got 84 on the 84 on the downside, and then 116 for the category. So this thing did way better than the category on the downside on the 5-year. And then if we take a look at the drawdowns, negative 20 versus the category, and the index actually quite a bit more. So, you know, that's more volatility. So you just take that into consideration. If you were someone who would take your money out of the market if you lost 20%, think twice before getting a fund like this, or maybe even in general growth ETFs, right? And then peak to drawdown, 4 months again. This actually was in 2018, so not exactly 2020 like these other ETFs have been. Next up, number 2, we got we have a choice of 2. We have the VanEck Vectors Oil Refiners, which is ticker symbol CRAK. So I know that a lot of people don't want to invest in oil. They don't agree with the morality of it and all that stuff. So I included a clean energy ETF in here as well. The Invesco WilderHill Clean Energy, which is ticker symbol PBW. So I'm going to give you 2 here. So hey, giving you a little bonus. You know, I'm over delivering on this one, guys. Over delivering, guys and girls. So The fund description: VanEck Vectors Oil Refiners ETF. It replicates as closely as possible the price yield performance of the MVIS Global Oil Refiners Index. That is that. Okay, let's keep going. Expense ratio 0.60, higher than we've seen before, so a bit high. The 5-year category rank, it's in the top 1% of its category, so it's in the top 1% best ETFs in its category. Now here's where things get interesting. It's underperformed the S&P 500 over 5 years by negative 55%. And you might be saying to yourself, Robbie, that is terrible. Why would you put this in there? Well, it's because I like the sector. Again, I think that the sector is going to outperform this year, and I think you have a lot of potential upside. That's why I like it. So I think that's what's going to happen, and if it doesn't, I could be wrong, right? So it's got a good distribution yield, though. If something happens and it doesn't work out, at least you get a little distribution yield, 2.64. Okay? Next up, CRAK's top 10 holdings. So Phillips 66, you've probably heard of it before, right? So if you've never heard of any of these other ones, Phillips 66 is one of the ones. Anyway, they're all oil type companies, right? So refiners. CRAK returns, again, the 5-year 7.22, not too bad on the 5-year. Of course, did not do better than the broad-based index here, but on the 3-year, it's the average return is negative 4.67%. So you lost money over the 3-year, and then over 1 year you lost 11%. So again, it's been a very bad time for energy in general, energy stocks. I just think that the sector is so beaten down that I think it's got some upside. It's a 5-star fund according to Morningstar. The risk is low versus the category, remember, not versus all stocks, because as we saw, it's lost 55%. But the risk is low in the category, and it's high return. So that's what you like. We got volatility measures. Just take a look at this. I'm going to skip it pretty quick, but I do want to mention beta is high, pretty high. And then the category actually beta is really high, so it's actually way less than the category beta in the index. And the standard deviation's very high, but the category's standard deviation crazy high, along with the index. So take it into consideration, very potentially risky. So this is where things get a little crazy. We got an upside capture ratio on the 3-year of only 109, so better than the index in the category. But the downside, ouch, 179. You're getting all the downside, right? That's not good. You don't want it to be high. You want it to be a lower downside, right? Category 277, ouch. Maximum drawdown, negative 49.27%, ouch. Category percentage, even worse. Index, even worse. So it did better than the index in the category at least. On the 5-year, same deal, bloodbath, not good. But again, I like the sector. I think it's good this year. On to the next one. Actually, this is very important. CRAK only has AUM of 18 million. Very important to consider before you invest in this. So just remember, it doesn't have a very lot of, the ETF does not have a lot of money in it. So sometimes there could be liquidity issues, things like that. Just do your research before you invest in something like this. Next, PBW. So this is the WilderHill Clean Energy ETF. Invest in clean energy. There you go. Moving on quickly on this. We're going to just go as fast as possible to get this thing not too long. I don't want such a long video. Expense ratio, 0.70. High, right? 5-year category rank, there is none because it's not 5 years old yet. The price change versus the S&P 500, OMG, 429%. So yeah, this has done well. It's outperformed the S&P 500 by 429%. The yield is 0.44. You even get a little bit of yield. The top 10 holdings. These are all the top 10 holdings. There you go. NEO's down here. Popular YouTube stock, NEO. Everyone's talking about it. PBW returns. The 5-year is great. I mean, it's 36.53% on the 5-year. On the 3-year, awesome. 62% on the 1-year. Ouch. Ouch. It hurts so good, more like it. 204% on the 1-year upside. I like it. There you go. So Next up, the risk. 5-star fund, according to Morningstar, average risk, above average return, what you want to see. Alpha, beta, so the beta is good. It's not a very volatile fund. Standard deviation is not too bad. On the 3-year, on the upside, 217% capture ratio. That is an amazing capture ratio. And only a 74 downside. Yeah, that's good. Same on the 5-year. So, this thing's done very well. It's had a maximum drawdown of 28% around the pandemic starting period. So, a little bit more than some of these other ones that, maybe normal would be about 25 to 22%. A little bit more, but okay, not too bad. Especially when you're getting this amazing upside. Finally, we have Ark Innovation ETF ARKK. This is the last one that we have today. Of course, I'm going to throw Ark in here. And by the way, if you want to watch my video on Ark, put it right here or in the description below. So Ark, essentially, Ark just invests in disruptive technologies. That's what they call it. And, Tesla's like its biggest holding. But we'll go through it in a second. But anyway, Kathy Wood's the fund manager. She's done amazing. And not just in this one ticker symbol of her ETFs. Multiple of her ETFs have just murdered the market lately. So she's doing very good. A 0.75% expense ratio, which she has justified in the 1%, top 1% of the fund. So the top 1% best in her category. The price change versus the S&P 500 over 5 years, only 568%. I mean, no biggie or anything. And distribution yield, 1.64. You even get yield, right? Pretty good. Of course, we have Tesla as the portfolio weighting at 10.55%. Maybe be wary. Tesla has had a monster run up. It's definitely a momentum stock. Momentum stocks tend to continue, right? But eventually they may run out of momentum and they may start hitting what you might call resistance in certain areas that finally bring them down like gravity. That might not happen. Tesla might just age into its earnings and cash flows and stuff like that. But we'll see what happens, But anyway, just be a little bit wary. But it does have other interesting things like CRISPR, so like genetic coding stuff. Then you got like Spotify, music. Of course, I have Spotify, so interesting. And then these are the crazy returns. So 45% for 5 years. Yeah, I mean, I would have loved to buy this 5 years ago. And then, of course, versus the S&P 500, 15.22% average annual rate of return, right? ARKK is a 5-star rating. It has a high risk, but also a high return, okay? Now remember, when I say a high risk, it definitely has a high risk. So just be wary of it. Just understand that if this is something you're going to invest in, if you don't want a lot of risk, don't put a ton of your portfolio into it. Maybe put a smaller percentage into it. Get a little exposure. It's possible. It's a way to do it. Alpha. Alpha and the beta. Okay, I'm just going to go real quick on the beta. Beta is 1.67. That's a high beta. So it's volatile. Standard deviation, 35.88. It's a high standard deviation. So lots of range and prices, okay? So just remember, it's not like just a very steady ETF. There's going to be some potential volatility. On the upside, 203. Very good. The downside, 119. It's got a little bit of a higher on the downside. But for the category, 96, but only 112 on the upside versus 203. So it's killing it on the upside. The downside, actually, maximum drawdown is not too bad. Negative 22%. That's actually great. And then over here, we have 214 on the upside for the 5-year. 150 on the downside. That's where it gets really rough. So it's really, you're feeling the downside on this fund in certain periods. So just know that it's possible that you're going to see some definite downside, but that's it. So those are the 5. Remember, just take a look at all of these, manage your risk correctly. Let me know in the comments if you like any of these, if you already invested in any of them. Let me know what you think. I want to hear your comments. And that's all we have for today's video. So thanks so much for watching. Hit the like button and watch another one of my videos, please, on the end screen coming up. right now.